Perfect. Thank you. Appreciate it.
Sure.
So welcome, everybody. Really appreciate you taking time out of your busy day, out of your busy weekend to join us here today. I know it's Christmas season. If you're like me, you've got some Christmas shopping to do yet. In fact, I haven't even started yet. So that's on the docket here for this afternoon. But have some exciting information to share with you today. I mean, if you guys have been trading at all here lately, you've seen the volatility has returned in a huge way. We've seen some huge swings back and forth, and a lot of talk about people going to the sidelines, pulling money out of the market, waiting for things to settle down. As a full-time trader, as an active trader, this is the type of environment that I dream about. I mean, this is ideal for everything that we like to do on the options side. So I'm going to share with you some of our favorite strategies that you can use here right away to produce the big returns using low risk, high reward option strategies. So if you're brand new to options, maybe you've been trading options for years, I'm going to share with you our exact approach on a daily basis to generate a full-time income from the market. So let me go ahead and dive in here. A little bit about myself here before I get into the meat of the presentation. I started trading back in 2002. I was a finance major in college at the time. Poor college student, didn't have access to any funds to trade with, and it drove me nuts because here I was gaining all this knowledge, figuring out how the markets work, and I had no way to apply it. Well, that's when I stumbled across the options markets and was fascinated from day one. You know, you show a college student a way to make some quick bucks with very little capital. I mean, that's attractive, right? Was addicted from there. Had some mixed results for the first couple of years. I made all the dumb mistakes you can imagine. I had the chance to go down to the floor of the SIBO, or the Chicago Board Options Exchange, when there was actually traders down there. Had the opportunity to interact with some of the professional traders, and I immediately realized how differently they approach the markets. They were thinking 3, 4, 5 steps ahead, whereas I was basing my decisions off of what I was hearing on financial media, what I was hearing other traders talk about. I was essentially trading off of a hunch. I had no system in place, and that was really what was holding me back from seeing the consistent return. So I knew right then and there I had to take a step back. I had to get a system in place that would guide me on every single trade. And that's when I came across NetPicks and their trading products. And it was really the missing piece for me because they're very big believers in providing detailed trade plans, detailed rules, exact entry, exit points before you ever get into a trade. And that's what I needed. Started out as a customer of theirs. I had some great success. I have been a coach for them for the last 13 years now. So I've had the opportunity to work with thousands of traders. And you know, I heard John get the question here a few moments ago. You know, if you're making such good money from the markets, well, why do this? Why work with other traders? And I would agree. It's because it's my passion. You know, in the first couple of years that I traded, it was difficult because I had no one there to help me. I was winging it on my own. I didn't have anybody there to prevent me making those dumb decisions. So I determined early on in my career that if I ever had the opportunity to make the consistent returns, I was committed to helping others along the way. And what I have found over the years is I learn just as much from our traders as hopefully they learn from me. I love the ability to bounce ideas off of other traders, to push and hold each other accountable. It's really a benefit for me as I continue to grow as a trader over the years. I have dabbled in other markets. I have done some day trading. I do trade futures from time to time, but my core focus is swing trading with options. That's how I make my full-time income from the markets. And I'm going to share with you today some of my favorite strategies to produce the consistent returns. So what we're going to be covering over the next 45 minutes or so, I'm going to share with you my 3 favorite option strategies that are going to improve your results immediately. These are strategies that are going to set you up for any type of market that we see going into 2019. There's a lot of opinions on what could happen, what should happen. Is the economy going to completely fall apart? Are we going to see a bear market? The bottom line is everybody has an opinion on what they think will happen. No one knows. So what I like to do with my trading is base my decisions off of numbers and statistics, not off of expert opinions. Right? Because bottom line is most opinions are going to be wrong long term. So I'd rather use proper option strategies to put the numbers in my favor. That way, it really does not matter what my outlook is for the economy 6-12 months from now. My focus is on what's going to come in the next couple of days, the next couple of weeks. I'm going to show you how to diversify with trades under $100. I know a lot of retail traders start out with the small accounts, and that's fine. I'm going to show you how to properly diversify. That way you're going to set yourself up for consistent returns over time. I'm also going to show you how to use credit spreads to simplify your trading in a safe way. Now, initially, when people hear about credit spreads, it's one of the most misunderstood terms in the industry, in the options industry, in my opinion. It's also the most misused type of trade. And it's unfortunate because if you use them properly, there are some of the most powerful trades that are out there. So I'm going to show you my exact criteria that I look for in my own trading. And along the way, I'm going to show my favorite indicators that we use to find the best setups and our favorite markets that we like to trade on a regular basis. So we have a lot of ground to cover over the next 45 minutes. If you have any questions along the way, feel free to type those in and I will get to those as soon as I can. Before we get to the slide, just really quick on the risk side, I do have to cover this. I know we've all seen it. Trading does involve risk. Past performance does not guarantee future success, but what we're going to show you today is how properly controlling your risk is the key to becoming a successful trader long term. A lot of times people make the mistake of trading very large position sizes, way too large for their account, looking for those instant results, right? In reality, if you can keep that risk as small as possible, we know we're going to have winners, losers, break evens, but if we keep that risk small, we are prepared for all three of those outcomes. So why do so many options traders fail? Bottom line, there is a 90% failure rate in this industry, and it's probably even higher, right? Bottom line is there's some very common mistakes that are made. And I included this a little screenshot here, this little video. This describes, I know the first couple years of my own trading career perfectly, but it also describes a lot of other people out there, right? You get started in the markets, you find an area like the options markets, you see the profit potential, you're excited, you jump in with both feet. Next thing you know, a couple months later, you're flat on your face, right? You blow out the account. I did that numerous times in the first couple years of my trading career. And it drove me nuts because here I saw everybody around me touting all their impressive returns, and I had nothing to show for it. And all of my hard work was just seemingly worthless. Well, when I started to dive in and take a closer look at my own experience, and then after working with thousands of students, I see the same mistakes being made all the time. And it really boils down to four main areas. First, we've already talked about taking risk way too large for your account size, with the outlook that, hey, if I just hit it big a couple of times, hit a couple of big winners, it changes the whole ball game for me. And at that point, I'll start to cut back and take smaller risk. And that's completely backwards thinking. What I want you to do is take smaller risks, take a larger number of smaller trades, spread that risk into many different areas. So many people focus on taking 1 or 2 trades and hoping for the best. In reality, I'd rather have you take 6, 7, or 8 very small positions. I'm going to show you how to do that here today. That's going to increase the odds. It's going to increase the numbers in your favor long term. Not having enough diversification, it's a huge issue. And a lot of times when people hear about diversification, they think immediately about having a mix of different stocks, different ETFs. And that's certainly a big part of it. But we take a different approach at NetPicks. The beauty of trading options is that we have tremendous flexibility. There's different strategies that we can use for different types of market conditions. There's different expiration cycles. We have weekly, we have monthly options, for example. There's things that we can do to add in layers of diversification that you just can't do with any other market out there. So we want to take advantage of that. We want to have a mix of different markets. I want to have a different mix of different strategies. That's a huge piece of the puzzle for us and how we trade. Trading the wrong options. For those of you that have traded options, you can probably relate to this. Initially when you start out, you're looking to keep that risk as small as possible, looking for the home run winners, right? In many cases, people come in and they trade the cheap out of the money options. The problem is those options, they're cheap for a reason. And I'm going to show you that here in just a moment, how they're cheap because they have a very low probability of making you money. I would rather set myself up for higher quality positions that are going to produce better consistency long term. And then finally, not having a defined system in place, giving exact entry and exit points. I'm a big believer in having that methodology in place that you stay disciplined to every single day. And that was the missing piece for me for so many years. If you don't have that system in place, you're going to be left trading off of emotion. You're going to be left overreacting to every little Trump tweet that comes out on a daily basis, seemingly these days. You're going to overreact to every little headline that comes out, and it's not a good place to be in. In this type of a market, when we're getting big moves back and forth, it's going to chop you to death. So what we want to do is get that system in place, base our decisions strictly off of numbers and statistics. And when we do that, I think you'll be amazed at how quickly your results will improve. Now, in our opinion, there's two main styles of options trading, and they're crucial. They build off of each other, and I think it's important for people to have both styles as part of their trading toolbox. The first style of trading options is strictly buying long calls and long puts. You have a directional outlook for that stock or for the market as a whole. If you're bullish, you're buying the calls. If you're bearish, you're buying the puts. Very basic, very straightforward, and it can be a very powerful approach to the market. They can produce some very big profits with limited risk. The problem is these trades only have one way of making money. If I buy a call option Monday morning expecting this market to head higher, expecting that Santa Claus rally to kick in, the only way I make money on that position is if that stock moves higher, and it does so quickly. If it doesn't move high enough, or if it doesn't move quick enough, I'm in trouble with that long option position. Now, it's not the end of the world. It's not a deal breaker. I love to trade long calls and long puts. But if that's all you're ever going to do, you're going to limit yourself. In a market like we're seeing right now, when we have huge range, the Dow is showing 600-700 point swings on a daily basis, you can make money with this approach. But we all know going into 2019, we're not going to continue to see the type of range that we've seen over the past few months. It's not statistically possible. We're going to see things start to slow down. We're going to see stretches where the market gets choppy, and that's when people get into trouble. You can make money when the market's active like it is now, but when it starts to get choppy, that's when you start to give all that profit back, and you're just left spinning your wheels, right? Been in that situation so many times in my own personal trading. So that's where the second style of trading really kicks in, and it's selling credit spreads, or what we like to call premium collection trades. So these are the types of trades where I'm going to sell a vertical spread to put a position on. Here's why I love these types of trades. They do produce smaller profit potential, which for many people, they tend to shy away from this approach because they think there's not enough money to be made. But I love them because it gives you 5 ways of making money on each trade. I'm going to show you here in a moment where I don't need a big directional move in the stock. I can actually put on a credit spread that's going to make me money if the stock moves straight sideways. If it stays inside of a choppy range, we can still generate some income. You're going to see a much higher probability of success. It's a great feature. You're going to make money in many different types of market conditions. They take less time to manage. There's a lot to like about these spreads. On the flip side, they have a smaller profit potential. So there's pros and cons of both styles. I am not one of those traders that forces you to pick one or the other. I love to marry these two approaches. When you combine the two approaches, that's when trading options gets fun. Because now I don't care if the market moves higher. I don't care if it moves lower. I don't care if it just moves straight sideways, if it just gets choppy. If I have multiple types of option strategies that I can use, I can react to many different types of market movement. Doesn't guarantee I'm going to win on every trade. I know that's not possible either. I'm going to have winners, losers, and break evens. But when I have a bigger toolbox of products that I can go to, it's going to allow me to react to different types of markets. As market conditions change, that doesn't bother me. My system's not going to break down as soon as the markets change. So let's talk about the first style here first. Let's talk about those short-term directional trades, talking about buying call and put options. There's 5 mistakes that you'll really want to avoid. If you're brand new to options, maybe you've never traded an option before, I encourage you to start out with the basics. Start out with buying the calls and the puts. You can make good money with those strategies. What I'm going to do long-term is encourage you to add in some of the vertical spreads down the road, because that's going to bring in the consistency side of things. But if you're going to start out just trading long calls and long puts, there's some key areas that you'll want to address, and you'll want to try to avoid these mistakes. First on the list, do not trade the cheap out of the money options. This is where so many people get the start, because let me go to the next slide and show Apple. At the time of this screenshot, if I wanted to come in and place a bullish trade on Apple, I expect it to move to the upside, I could come in and buy the 220 calls. Okay, and they're cheap. They were trading for around 95 cents or around $95 per contract. Very cheap bet. You come in, you buy that option saying, hey, if Apple moves higher, I make money. Worst case, I'm out 95 bucks. I can handle that. Here's the missing piece. This is where a lot of people overlook. Notice I have the 86% number here that I'm circling. One of the columns on my trade page here is the probability out of the money column. That 86% number is telling me the probability of that option closing out of the money. When I say out of the money, it's telling me the chance of that option expiring worthless. There's an 86% chance of that happening. So this option is cheap. It's only 95 bucks, but you only have a 14% chance of making money on that position at expiration. You know, if you take a look at it, I don't know many people that are going to get excited about a 14% chance of making money, but yet so many people go to those cheap out of the money options and trade those exclusively. What I'm going to show you here today is how you can increase your odds of success by adjusting your strike prices, by going with some higher quality in the money options. They're going to be more expensive, but I'm going to show you a few shortcuts, a few tips to how to lower the cost. And in our case, we're lowering it by 30 to 50%. So you're going to have a higher quality position on with not a lot of additional capital at work. So staying away from the cheap out of the money options, that's going to be the first mistake to avoid. Second, trading with weekly options exclusively. I love weekly options. Don't get me wrong. I think they are incredibly powerful. They're very exciting to trade. They can produce some very big profits quickly. The problem with trading them exclusively is they are extremely aggressive. There's a time and a place for them. I'm a big believer in mixing up your weekly and your monthly options. And if you do that, you're going to be able to better react to different types of markets. Next, limit yourself to long calls and long puts only. Again, we've already touched on this. If that's all you do, you can make money, but you're going to see bigger swings in your equity curve. When the going is good, you're going to see incredible growth in your account. But when it gets choppy, that's when you start to give back all the profits. Whereas if you start to add in some vertical spreads, now we fill in some of those missing pieces to the puzzle, and that's when trading really starts to get exciting. Not having enough diversification, mix your markets and trade types. Again, we already touched on this a few moments ago. Not only mixing the markets that you trade, that's a big part of it. I do want you to have a mix of different stocks and ETFs, a mix of different sectors, but I also want you to mix up your trade types. Get some vertical spreads in the mix. Get some weekly and some monthly options. Those are all ways of layering in different diversification. And finally, trading off of emotion, not knowing where to get in and where to get out of trades. I teach this on a weekly basis to our students because this is the biggest mistake that people struggle with. You know, if you trade off of emotion, I don't know too many traders that are good at it long term. You might hit a winning streak. You might get lucky from time to time, but you're not going to see the consistent growth. If you have that system in place ahead of time, it solves so many issues for you. And I'm going to show you some of our rules and some of our criteria that guide us on a daily basis. So the mistakes here, the 5 mistakes, we're gonna address these over the next few minutes. We're going to take a look at some of the trades that we have taken here recently and show how we can address these and how we can prevent those types of mistakes from causing any type of painful losses in your account. All right, so a lot of times people ask, when they're learning to trade options, how do I know what option to trade? Do I trade the weeklies? Do I trade the monthlies? What expiration cycle or what strike price do I go with? Here's the criteria that I use on every trade. So when I talk about the long calls and puts here today, when I talk about the vertical spreads, I am going to share with you our exact criteria that we use on every trade that we take. So there's 4 steps for trading long calls and long puts. Number 1, do not take a trade unless you have an entry and exit plan in place. Are you starting to notice a theme with today's presentation? It's such a huge issue. It's such a glaring weakness for so many people. You have to have that plan in place before you ever put a hard-earned dollar of your own capital on the line. Step number 2, look for options with between 20 and 40 days left. It does not matter to me if that's a weekly or a monthly option. As long as there's between 20 and 40 days left, that's going to be the sweet spot for us. That's what's going to allow us to see the explosive returns if we get a big directional move in our favor, while also starting to limit the time aspect, limit the time decay of those options. We also are going to be looking to trade the options that are 1 to 2 strikes in the money. So when we have a trade trigger in, let's say you're bullish on Apple, you're looking for a bounce in Apple going into next week. You want to go ahead and buy a call option. Go 1 to 2 strikes in the money when that entry point is hit on your chart. Okay, you're going to pay a little bit more for those options. They're not going to be as cheap as those out of the money options, but you're going to start to stack a lot of odds in your favor if you do so. And then step number 4, look for open interest of 30 times the number of contracts you're going to be trading. For example, if I'm looking to buy 10 options, looking to buy 10 call options, I want to make sure that I've got 300 contracts of open interest at a minimum. And the reason we take this approach, it's not necessarily a big issue if you're looking to trade 1 or 2 contracts. There's plenty of different liquid products out there. Where it becomes an issue is if you've got a bigger account size and if you start to grow your account over time. If you do not pay attention to liquidity, it's very easy to get stuck in trades, meaning you can't get in and out quickly and at a good price. Not a good position to be in. Been there. I've had it happen. It's not a good feeling. So you really want to pay attention and start to program yourself to look for volume and open interest and make sure that there is good activity there in the option that you're trading. Now, this criteria, it does not matter if I'm trading Apple, Amazon, Netflix, Citigroup, Bank of America. This is the criteria that guides me on every position. The mistake that people make is when they come in, they try to decide what call or put option to trade. A lot of times people choose the option that they think that they can afford, right? The option that allows them to get in at the lowest price point. And like we've already shown, a lot of cases, that's going to leave you with an option that just doesn't have good odds in your favor. Instead of focusing strictly on price, I'd rather have you use this criteria here. Use these 4 steps to guide you, and that's what's going to increase your performance in a big way. So the long calls, long puts, this is why we all love to trade these markets. Look at this P&L graph. I mean, who wouldn't love this P&L graph? If you buy a long call, you have unlimited profit potential, right? Just like buying the shares of stock. The difference here is with the option, because they are leveraged products, I'm going to be able to have that unlimited profit potential with a much lower cost. And my maximum loss, my risk is limited to whatever I pay for the call or the put option. So phenomenal looking P&L graph. If I go over to the long put P&L graph, very similar view. I mean, you've got the unlimited profit potential with the limited risk scenario. That's why I love to trade these products, especially in today's environment. We all know all it takes is one Trump tweet, one headline with the whole trade war situation with China or the whole Brexit situation that keeps popping up. All it takes is one news event and this market is off to the races in both directions, right? By having those risk-defined trades on, I feel much more comfortable about my trading. I sleep better at night. I'm more comfortable holding positions, staying disciplined in my system because I know I'm better able to control my risk. So let's take a look at a couple of trades. Let's start to put this into practice and show you how you can apply this criteria. This is a chart of Caterpillar. Okay, Caterpillar, I've traded it now for years. It's had a very significant shift over the last couple of months. In the past, Caterpillar has been one of those big stocks, doesn't move all that quickly. But because of this whole trade war situation, this global economic slowdown that everybody's talking about now, Caterpillar is essentially trading, in many cases, like a high-flying tech stock. It has been very active all year long, a lot of big moves back and forth, very liquid. It's actually been one of my favorite products to trade, and I never would have said that 2 or 3 years ago, but it is now. It's been phenomenal for us. So the blue and the pink dots on the chart, this is our options fast track system. It's a set of custom indicators that we use to identify entries, targets, and stops. The goal of today's presentation is not to get into the nitty-gritty details of what makes a setup here. I want to focus more so on how we select the proper option to take the trades with. Down at the bottom, we have the Williams percent R indicator. It's one of my favorite indicators to use to identify overbought and oversold extremes. We do use some custom settings inside of that indicator. On its own, that indicator cannot be used to identify entry and exit points. But it's a big step in our sequence to identifying the overbought and oversold conditions. When I see the blue dots on my chart, the first series of blue dots here above price, that's my entry point. I have 2 targets up above, and I have my stop down below. We have a very specific set of criteria that we look for in a trade. And when that criteria is met, we get the exact trade profile to print for us in real time. So before I ever put any money on the line, I know my exact plan of attack from start to finish on the trade. This is what I was talking about earlier. Having a system, having a rule set in place that'll guide you from start to finish. So now there's no guesswork involved. It's either a setup or it's not. And before I ever get into a trade, I know exactly where I'm getting out ahead of time. So now I'm able to limit that emotional aspect of trading. I'm not trading off of a hunch. I'm putting numbers and statistics in my favor. Now, I don't care if it's this system or any other system out there. Maybe you have your own set of indicators that you like to use. That's perfectly fine. I just want you to be able to sit down with somebody and in 5 to 10 minutes, explain what your system is. How do you know where to get in and where to get out? And if you can't do that, I would highly encourage you to take a big step back here over the holidays. Spend some time between now and the end of the year and really get that rule set, get that system in place that's going to guide you on every trade. You're going to find it's going to make a huge difference in the long run. And there's just so many indicators out there. There's a lot of different ways that we can slice and dice things. Again, I don't care what the system is, as long as you have a methodology in place that you can commit to, that you can stay disciplined to. Now, when I hit my entry point here, when I hit the first series of blue dots, the system's telling me we're looking for a move higher in Caterpillar. A typical holding time for us is anywhere from 2 days on out to 2 weeks. That's very typical for us. It's what we classify as a swing trade. So when I hit the entry point, I know I need to put a bullish trade on. Could I come in and just buy the shares of stock? I could. However, you go in and try to buy, 1,000 shares of Caterpillar, it can get expensive, right? It's a $116 stock. So what we did is we came in and we bought the 116 calls, controlled 100 shares of Caterpillar stock at 116, but I'm only paying $455 per contract. That's the leverage that the options offer. So now all of a sudden, even if a small account size is being used, you're able to put on a decent sized position on Caterpillar. Not to mention the options are going to react very quickly to changes in stock price. And that's exactly what happened here. Notice I came up and hit my full second target within 2 days. We were in and out of this trade in 2 days. We sold out of the position, booked a $355 profit. It's a 78% return. That's exactly why I got attracted to these markets. A 78% return, $355 profit in 2 days. That's a nice little supplemental income right there, if that's all you did with one contract, right? Now, the issue here, there's a couple of potential issues. Number one, maybe you're looking at this saying, okay, I've got a $5,000 account. If I put $500 into one contract, that's really not smart money management, right? It's just too much risk into one trade. And I would completely agree with that. I'm going to show you here in just a few moments how we can use a couple of other option strategies to reduce your cost. And I'll show you how to reduce the cost by 30 to 50%. Okay, the second issue here with this option is maybe you don't want to be as aggressive. Okay, and that's fair. Maybe you look at this market and say, well, damage has been done here lately. Every rally has been sold. The damage had escalated again last week. Maybe you don't want to be as aggressive on the upside. And that's fair enough. I'm going to show you how a vertical spread can allow you to put on a bullish trade with a much more conservative outlook. Now, all of a sudden, you have the flexibility there. You can control your risk, not strictly through position sizing, but through the option strategy that you use. That's when trading really starts to get fun. Now, in the case of Caterpillar, this was a bullish trade. I was looking for a move to the upside, and we were rewarded for that. We did get a move higher, and that was just a great return. But I also know, we've seen it here lately, that markets can move lower. And in fact, we've seen it in a big way on many products lately. I don't care if the market moves higher or lower. You're never going to hear me fall into the perma bull camp or the perma bear camp. I just want the market to move. That's all I care about. with the use of options, if you start to get in trade options for any length of time, you're going to find yourself looking for market moves to the downside. Things happen quicker. Things escalate quicker on the downside. That's why I love it when this market does what it's done over the past few months. It just provides tremendous opportunity. And that's why it really bothers me when I hear so many people talking about pulling money out of the market, going to the sidelines, waiting for things to settle down. Because as an options trader, this is what we live for. This is what we want to take advantage of. So here's XLE. This is the energy ETF that we like to trade. Unlike Caterpillar, we were looking for a move to the downside, and you'll see the pink dots that I have over here right by that red arrow. That was identifying the entry, the targets, and the stop for me. Again, I'm not going to have time to get into the nitty-gritty details of what makes that a setup. My point being here, I want you to have a system in place, whether it's this system or any other, that is going to identify those key levels for you. Because when you get that in place, it allows me to focus on identifying the proper option to take the trade with. So what we did is we came in and we bought the 77 puts, $194 per contract. Those put options are going to increase in value as that ETF moves to the downside. That's exactly what happened here. We ended up closing out of half of the trade, booked $134 profit, 69% return. We closed out of the second half of the trade a couple weeks later. We played this whole move to the downside. See how my pink dots continue to move in a stair-step fashion on the way to the downside? Over those couple of weeks, we were continuing to lock in more and more profit every single day. We ended up closing out of the second half of the trade, $959 of profit. That's a 494% return. Now, all of a sudden, you're quickly talking about going from a supplemental income to potentially replacing an income, depending on how many contracts you're trading. Now you're saying, well, what if I can't trade multiple contracts? Well, the beauty here, I only tied up $194 of capital. You trade 2 contracts, you're talking about less than $400. Most people can afford that type of a risk, right? So phenomenal return. You take a look at Caterpillar, XLE, very different markets, right? Caterpillar, individual stock, XLE, an energy ETF. We're starting to build in some diversification there, right? One is a bullish trade, one's a bearish trade. A lot of profit potential here, right? These are great positions utilizing long calls, long puts. And again, it's a big part of what I do on a daily basis. However, like we've already talked about, what if I want to be more conservative? What if I'm going to reduce the cost, reduce the risk on the trade? Or maybe, I just flat out don't want to be as aggressive. Maybe I just don't have as bullish or a bearish outlook. So what I can do is what's called a vertical spread. Now, many of you might already be using these strategies. And if you are, that's great. You're already seeing the power here. When I talk about a vertical spread, all it is doing is buying a call or a put, just like we talked about on XLE and Caterpillar, but then at the same time, we're going to sell an option that is further out of the money. So we're going to trade 2 different options at the same time. It's going to be done as one trade. And the beauty here is it lowers the cost by 30 to 50%. It still gives me tremendous profit potential. I'm just lowering the risk on the trade. So if we take a look at the P&L graph, if I take a look at buying a call spread, so instead of just buying the outright call, I buy the spread, I still have limited risk, okay, just like we took a look at on the earlier P&L graph. The difference now is I have a limited profit potential. I'm capping my profit potential here as well. Not a deal breaker. It's still a great opportunity for me. Okay, and in many cases, it's a fair trade-off, right? I give up the home run profit potential in exchange for much less risk. And I use these types of strategies in my own trading all the time. They're not just limited to the small account sizes. I've got students that are trading 7-figure accounts and all they do is trade the vertical spreads. They don't need the cost savings. They just like the ability to better reflect their level of aggressiveness and their risk tolerance. So let's circle back. Let's go back to the Caterpillar example that we just talked about a few moments ago. We talked about buying the calls for $455 per contract. So again, if you want to reduce the risk, maybe it's too expensive for your account. Maybe you don't want to be that aggressive. Let's take a look at this same chart pattern, the same trade, but now let's talk about a call spread. Same entry point, same targets, same stop. None of that changes. The only difference here is now instead of just buying the 116 call, I'm also selling the 122 call. Now I'm able to lower the cost all the way down to $254. Okay, there's a close to a 50% cost savings right there, right? So I booked the profit. I closed the trade out at the same target, booked $144 profit. That's a 57% return. Did I give up some profit potential? Yes. On the first trade, what did we have? An 80% return, 90% return. I gave up some profit potential. I only had a 57% return, but I took the trade with half the risk. Now, all of a sudden, that opens up doors for higher price stocks, for you to potentially trade bigger positions, multiple contracts. You're better able to control your risk strictly by adjusting the option strategy that you're using. That's the only thing that we're changing here. If I go forward, here's the put spread, very similar looking P&L graph. You know, limited risk and limited profit potential. Again, it's a fair trade-off, and here's why it is. If I go forward to Netflix, here's a bearish position that our system called here recently. If all I did is come in and buy 375 puts, we're talking about almost $2,500 per contract. They are very expensive. For some of you, that might not be an issue. Maybe you've got the bigger account size. If you do, that's fine. If you can handle the risk, look at the profit potential here. Almost $3,200 of profit on the first half of the trade. It's 129% return. Almost $2,000 of profit on the second half of the trade. That's an 81% return. That's phenomenal, right? I mean, that's quickly replacing an income. The problem here is the $2,500 minimum requirement to put on this position. If you are a smaller retail trader, that's expensive, right? It's rich. Well, let's go forward, take a look at the same exact chart, the same exact setup. Let's just look at it utilizing a put spread. So I'm still buying the 375 puts, but now at the same time, I'm going to sell the 320 puts. And it lowers my costs all the way down to $1,883. I save $600 to use the put spread instead of the long put. Now, it's still expensive, right? I get that, but you're drastically reducing the cost of the trade. Do you give up some profit potential? Sure. Now, all of a sudden, our profits go down to $1,800. It's still a 98% return. It's still a phenomenal return. And then also $1,100 or a 59% return on the second half of the trade. So it's a fair trade-off because we're saving some on the cost of the trade. We still have a phenomenal return potential. This is a great way to potentially open up the door to trade some of the higher priced products. That's why I love to use the vertical spreads. Now, so far, what we just got done talking about is buying the vertical spread, buying the long spreads. And here's the criteria that I use. So even if you don't fully understand what a vertical spread is, here's the criteria that we use on every trade. We're looking for between 20 and 40 days left to expiration. Okay, we talked about that with the long calls, long puts earlier. I want to buy the option that's one strike in the money. So from wherever I want to get into the trade, anytime that we hit an entry point with the price of the stock, I'm going to buy the option that's one strike in the money. And then I'm also going to take a look at selling the strike that's as close to the second target or as close to my target price on the chart. And by following this criteria, you're going to lower the cost by 30 to 50%. You're going to give up some on the profit potential, but you're still going to have an incredible return. So this criteria can be used on any stock or ETF. Amazon, Caterpillar, Bank of America, it's all the same criteria. That's the beauty. We're trying to give you a methodology that you can trust on every trade. But we can also take it one step further. Those are two of my favorite strategies. The third one, and the one that is least used with most options traders, is the credit spread. If I buy the spread like we just talked about, it's still very much a directional trade. I only make money if that stock moves in my favor and it does so quickly. If I sell the spread, as you'll see in a moment, the beauty there is I'm giving myself 5 ways of making money on the trade. Okay, so let me go to a chart example. Let's go back to the example on Netflix. Okay, the first trade that we talked about, right, is talking about buying the long puts, and it was going to be $2,500 per contract. We then turn it into a long put spread where we lower the cost to $1,800. On both of those examples, they're still expensive. Let's take a look at a third way to take this very same Netflix short trade. And it's selling a call spread. Selling a call spread is a bearish position. I still want that stock to move to the downside. What I did here is I sold a 380 call, and at the same time, I bought the 382.5 call, and I collected $102 per spread. That's the most money that I can make on the trade. That's my maximum profit potential, which, sure, I mean, it pales in comparison to the long put, right? Where we had thousands of dollars of profit potential. But here's the difference. It only tied up $148 of capital to put on the spread. Maybe you can't afford $1,800 to $2,500 to buy the individual option, but most of you can probably afford $148, right? Now, all of a sudden, you've got a whole new universe of products that you can trade. You can trade Netflix, you can trade Google, you can trade Amazon, and keep that risk to a couple $100 or less. The beauty here also is I have 5 ways of making money on the trade. I need the price of the stock to stay below 380. That was the short strike. That's the option that I'm selling to put on the trade. As long as it stays below that number, I don't care if it moves up, down, or sideways. As long as it stays below that number, I make money. I make money from the time decay adding up, and I make money from the volatility decreasing. So now I have 5 different avenues to make money on the trade. Do I have the home run profit potential? I don't. If you want the home run profit potential, the long put is the way to go. But now I give myself a much higher probability of success. And I use these trades all the time in stretches where I'm a little less certain on the market making a big move, or a stretch like we're seeing here going into next week. We're going into the holiday season. Chances are the volumes are going to start to lighten up. You know, people are traveling. They've got holiday parties to attend. If the market is expected to slow down and get a little choppy, the credit spreads are a great way to stay involved, to get some trades on without needing the market to make a big move. And when you start to combine these different strategies, again, it's going to be what produces the really consistent returns for you over time. Let me simplify it one step further. Here's IWM. I take all the indicators off the chart. There's not a single indicator on here. We're strictly looking at price. You can clearly see that price action had a big move lower. Along with the rest of the market, we are very oversold here. Instead of just coming in and buying a long call, which only makes money if IWM moves higher, I came in and I sold the put spread. I sold the 148, 146 put spread, and I collected $66 per contract. Okay, it doesn't seem like a huge profit potential, only $66, but it only tied up $134 of capital to begin with. I make money if it moves up, down, or sideways. As long as it stays above that horizontal line there at 147.34, I get to make money. We closed out of the position for 16 cents. It gave us a $50 profit. I made money if it moved up, down, or sideways. I made money as time decay added up, and I made money as volatility decreases. So I made $50 here in a matter of days, and I didn't even need a big directional move in the stock. That's what excites me, because now I'm able to react to multiple different types of market moves. So here's the criteria for the credit spreads. We're still looking for between 20 and 40 days left to expiration. I want to collect between 30 and 40% of the width of the strikes. So for example, if I'm trading a spread where there's a dollar-wide difference between the strike prices of the options that I'm trading, I want to collect between 30 and 40 cents. Okay, that guides me on any stock that I'm trading. Netflix, Amazon, IWM, it's the same criteria. And my target level on those trades, I'm looking to keep between 50 and 75% of whatever I collect to put the trade on. Now, which strategy is best? I mentioned earlier, I like to marry the approaches. I'd like to use a combination of the trade types. The most conservative trade is the credit spread. It's going to have the lowest risk, the lowest reward, but it's also going to give you the highest probability of success. You're going to have those 5 ways of making money. Moving on over, if you want to get a little bit more aggressive, the debit spreads are the better way to go. You're going to lower the cost by 30 to 50% when compared to just buying a call or a put, but you're also going to have a lower reward potential. The most aggressive is, like we talked about earlier, the long calls and long puts. You're going to have the most profit potential, that you're also going to have the most risk, and you only have one way of making money. So there's a time and a place for all 3 of these. If you utilize all 3, you're going to see much better consistency over time. Now, maybe you're looking at this, maybe you're brand new to options, maybe you're wondering, can I trade this way? Can I have the same level of success that we've shown here in the last 20 minutes? Okay, I get it. There's a learning curve. Anything that's new in life, it takes time, right? Maybe you've had bad experiences trading options in the past. Maybe you've blown out your account. Maybe you're hesitant getting back in. Well, bottom line is we can't go back and reverse the past. We can't refund the account. I wish I could go back and refund my first couple of accounts years ago. It would be great, but we can't. But what we can do is change things going forward. We can get those rules in place. We can get that methodology in place that's going to allow you to make money from 5 different market scenarios. So don't let the past hinder your future success. If you're not happy with your returns, I would challenge you, look into some different approaches, consider some different strategies that are going to make trading so much easier for you. Here's the best part. Everything that I've shown you today is part of what we call our done for you signal service. It's our spotlight option alerts signal service. You're going to be able to piggyback on our trades each and every week. The trades that I've talked about here today, maybe you're saying, Mike, you're talking too fast. I don't understand what you're talking about as far as vertical spreads go. The beauty here is that we do all the hard lifting for you. We do the research, we find the best trade opportunities, and we send those out to you through email and in our private Slack group. And this is a screenshot of the Slack group. Slack is a program that you can put on your phone, any type of a mobile device. You can put it on your computer. It's free, and it allows us to quickly send out trade alerts, send you the exact details of the trade. You can communicate with us one-on-one, so you can get instant feedback. I've got Slack up all day long, so you'll have instant access to me throughout the trading day. So again, it's the Spotlight Option Alerts program. These are the same trades that I take personally on a regular basis. So you better believe I am committed to finding the highest quality positions. It's in all of our best interest, right, to find those best opportunities. And you're going to be able to piggyback off of all of that research that we do each and every day. So here's what it looks like. You're going to receive between 3 and 10 new trades each week. Again, through email and in the private Slack group that I just showed you. There's a private owner site where you can log into, find all the setup instructions. You can review open positions. We do provide weekly recap videos. That way you can come in, if you want to take your trading to the next level, you want to learn how to utilize these strategies, you're going to have access to all of that training in the private owner site. And then you'll also have unlimited access to one-on-one support with myself. Here's some other trades that we've taken here recently. I didn't even have a chance to get to all of these today. I mean, we're talking about thousands of dollars worth of profit. These are all trades that we sent out to our students. A lot of these trades, we're talking about tying up just a few $100s of capital, right? So it's not going to require a 6-figure account to take part in these types of positions. Now, the regular price of the service is $24.97 for 12 months access to the alerts. I'm not going to charge you anywhere close to that here today. In fact, I'm going to offer a price point that we've never offered before. I'm doing it here. Again, it's Christmas season. I want to make sure that we do our best to get you started here, get you on the right track for 2019 at the lowest price possible. So we're going to do $497 here today for 6 months worth of alerts. If you break that down, it's $83 a month for access to all of the trades that we take personally to make a full-time income. Okay, so all of the exact trades each week, the access to the owner site, to the Slack group, to the one-on-one support, it's all included for $497. So the link to sign up here at netpixtrading.com/TradeThirsty. We'll get it into the chat box as well. Jeanette, if we could get that in there, that'd be great. So if you're ready to go, I've only got 20 spots open at this price point. Guys, I just cannot bring on more than that. At this price point, it's difficult. There's not a lot of wiggle room on our side. So I want to make sure we get you access to that price point here today. If you're ready to go, we'd love to have you join us. We do have a couple of bonuses as well. We do include a getting started webinar where you're going to be able to get in. We'll walk you through how to set up your brokerage account, how to get your Slack program set up. We'll walk through more details on the vertical spreads. We'll have more time to cover them in detail. You'll have access to that webinar. And then also the pulse indicator training. I didn't get a chance to show the pulse indicator, but that's the indicator that we use to identify a lot of our setups. I mentioned it here earlier. It's so crucial to have a system in place that you can trust. Here's the indicator that you can use. It's programmed for Thinkorswim, NinjaTrader, or TradeStation. As long as you have access to one of those three for your charting, you can use the broker of your choice to take the trades with. This indicator, this system, it sells on its own for $497. I'm including that free of charge here for you today. So again, $497 for 6 months worth of alerts. It works out to be around $83 each month. and there's the link to sign up. So at this point, let me go ahead and take a quick peek at questions. Jeff asking, in order to take spread trades, what level of options account do you need? It'll depend on your broker. We are certainly willing to get you set up with the right access. I highly recommend that you use Tastyworks as your brokerage. Tastyworks was started by the group that started Thinkorswim years ago. They offer very low commissions. They don't have different tiered access. So if you have an account with them, you can trade any type of option that you want, any type of strategy that you want. Which is really, really nice. So we can certainly help you get that set up. Alice, what is the suggested minimum capital? You'll really want to have a margin account. We don't use the margin to trade off of, but you'll want the margin account to trade the spreads. And most brokers require a $3,500 minimum account to access margin. So between $3,500 and $5,000 is the minimum amount that we recommend that you start with. You can start with less than that. As far as trading goes, the problem there is we just can't control your risk. We want to keep that risk at a very manageable level. Carrie, how do we get access to the Slack group? Well, if you decide to sign up here with the offer today, we will certainly send you an invite to our group. And that way you can communicate with us one-on-one. You can communicate with the other members of the group. It really starts to build that community aspect that's missing for a lot of people. Which market has gone down Friday would you buy? Any of the index ETFs for the Santa Claus rally the next 2 weeks? Yeah, so KG, I do agree that a bounce is coming. I would expect it to come here over the next week and a half. I know we got Christmas built in there. There's a lot of oversold markets. I'm looking at the Russell, which is IWM, and QQQ. Those are the areas that I'd love to see bounce going into next week. So inside of those groups, I like Apple. I know Apple's been incredibly beat up. I think it's very due for a bounce. I like Amazon on the upside as well. And then the financials. The financials have been incredibly beat up. Now, I'm not saying that the financials are going to head higher and go back to all-time highs, but I do expect in the near term, I expect a bounce. And it's a very tradable bounce between now and the end of the year. And we've already got some positions on, but here next week, we will continue to add to those positions with our students. Do we have physical stops on options? John, we don't have actual orders in place for those stops. So we like to use price alerts. We do stay very committed to a stop price, but we like to manage those trades manually. So anytime that we open a position, anytime that we close out of a position, you will be notified right away with the exact instructions on what we're doing to manage those trades. And then John also asking, do you look at IV? Yes, we do look at implied volatility on every trade. We prefer to use more credit spreads when volatility is high, which is what we've been doing a lot of here lately. When volatility is high, options are expensive, and we're seeing that right now. So one way to take advantage of that is to utilize credit spreads. Now, earlier this year, when the volatility was extremely low, we were certainly using more long calls, long puts, long spreads because the options were very cheap and we could buy at a very low price point. So that's the nice part about having those different strategies. We can better react to different types of market conditions, and we can react to whatever the market throws our way. Do I ever buy spreads or only sell spreads? I do both, John. As I just mentioned, I like to be flexible. Options are the most flexible products in the world. I want to take advantage of that. I don't want to limit myself with one strategy. I like to use the flexible approach and utilize those different strategies. Am I bullish or bearish on KG? In the near term, I think the market is incredibly oversold. I think we're due for a bounce. That's going to impact how I trade over the next couple of weeks. Long term, I think there's a lot of uncertainty out there. I think we're going to be in for a stretch going into next year where there's going to be some continued wild volatility. I think we're going to see some big swings back and forth. So for me, I don't care what the market does long term. My universe, my area of focus is the next couple of days, the next couple of weeks. Because I think going out 6 to 8 months, there's too much that can happen with China, with Brexit, with the Trump administration. I mean, there's just too many unknowns. I would rather trade in the near term. And in the near term, I'm looking for a bounce here in the very near future. Carrie, TD Ameritrade is $2,000 for margin. Yeah, most brokers are in the $2,000 to $3,500 range. So yeah, it'll certainly depend on the broker. And if you need more information on that, feel free to reach out and we can certainly help you out with that in more detail. Last question here, Mike, on Tesla, is that chart resistance again? Would you buy puts or a put spread on it? Well, with volatility high right now, if you are expecting Tesla to move lower, I'd rather sell a call spread here to take advantage of the higher options. But if you're not willing to use credit spreads, Tesla's expensive. So I prefer to use a lot of vertical spreads. So if you're going to try to buy a put, I'd rather do a put spread. I think that's going to be a better use of your capital, just given the current environment. All right, guys, so I'm almost out of time. Just